So as we talked about in the last video, the balance sheet is a great tool for computing things like ratios to look at a firm's liquidity, its rates of return, things like ROE, ROA. It's a really great tool, but it has some limitations, and that's something we're going to talk about in this video. In the first limitation, and probably the most glaring, is that most of the items that are on a balance sheet are recorded at historical cost. So that means that when an item is purchased, the cost that it takes to get a trademark, to register it, that's what actually goes on the balance sheet, is the cost of registering that trademark, not the fair value. Not fair value. Now, sure, there are a few exceptions. We think about things like trading securities. We do record them at fair value. But for the most part, when we think of a building, we think pretty much anything, we record things at historical cost or some kind of variant of cost, not at fair value. And so that's kind of led to this thing where if you look at the value on the balance sheet, which I'll just abbreviate here, it's not going to be equal to like the firm's market capitalization, right? In the market cap, we're looking at basically that's the fair value of this firm, right? This is the value of the firm, or the value of the equity, I should say. And when we look at it, it's not even close in some cases to the balance sheet. And that's kind of this idea of historical cost. Now, historical cost is more reliable. These are more reliable numbers, but they don't have the relevance that something like fair value does. So some people might say, well, we look at a balance sheet, but we're just seeing a bunch of things that are recorded at cost. I don't care what they cost. I care what they're worth today. But also another limitation is the idea that a lot of these things in the balance sheet, estimates of managers are used to create them. So when we think about warranties in terms of any warranty liabilities, when we think about things like bad debt, we think about uncollectible accounts, and the uncollectible accounts are going to be netted out from accounts receivable. They're going to reduce the account receivable. So these estimates, these are just estimates by managers. And these estimates are going to be affecting basically the numbers that end up on the balance sheet. So there's some play there that managers have, and that's one reason that some people might say, okay, well, the balance sheet is limited in that regard. And also, we have to bear in mind that a lot of items do not even show up on the balance sheet. When we think about something like brand value, right? So let's think of a company like Coca-Cola. Coca-Cola, when we think of Coca-Cola's brand value, right, the brand name, I'm not talking just about the trademark and the cost to get the Coca-Cola trademark. I'm talking about the actual brand value that people can go and estimate and look and say, what is the value of the Coca-Cola name, the brand, how much brand value there's no place for that on a balance sheet, right? That's not an item that's even going to show up, even though that might be Coca-Cola's most important asset. And so again, that kind of gets into the idea of that we look at the value of the firm, its assets or its equity on the balance sheet is not necessarily going to be the same. It might not even be close to the market cap or the market value of the firm's equity. Now, related to the idea of omissions and things not even being on the balance sheet, there are certain things that firms or managers purposely do not want on the balance sheet, and that's this idea of off-balance sheet financing. So something like brand value, a firm would probably want that on their balance sheet. But off-balance sheet financing, the firm is actually, the managers are taking deliberate steps to get something off of the balance sheet. They do not want it on there. And what it usually is we're talking about some kind of debt, right? That's what we're talking about, financing. So the firm basically wants financing for some type of asset. They're going to borrow to get an asset, but they don't want that debt to show up on the balance sheet. And there's a variety of reasons for that. It might cause the firm to violate some kind of debt covenant. And so the firm's trying to avoid a violation. The firm might just be trying to trick analysts and making it look like it's not as heavily levered as it is. It just wants to look like it's not as risky. So in any event, I have another video on off-balance sheet financing, but the idea is that there are items that are just omitted from the balance sheet because there's just really no way of reliably measuring them. And then there are items that firms actually take steps to not put on the balance sheet. And for those reasons, the balance sheet, although a great tool, is limited in what it can tell us.